Hey everyone, welcome to our channel. If you're looking for a bold investing idea, you've come to the right place. Today, we're talking about China's stock market and why many analysts predict it might skyrocket in 2025. Now, I know some of you are thinking, why China? Isn't there too much uncertainty? But stick around because we're going to dive deep into the reasons behind these predictions, real-life examples of what's happening, and most importantly, how you can position yourself to potentially reap the benefits. And by the way, if you like the sound of making solid gains in 2025, make sure you smash that like button, subscribe to this channel, and turn on your notifications so you don't miss any of our future videos. Let's start by explaining why 2025 is being hyped as a potential takeoff year for the China stock market. Historically, the Chinese stock market has had cycles of about 6 to 7 years for its major bull runs. The last major surge around 2020 caught the attention of global investors. Now, if we follow that rough 6 or 7 year cycle, it puts us right around 2025 or 2026 as the next potential bull run. But cycles alone don't guarantee anything. They merely hint at historical patterns. According to a research note from Goldman Sachs, many market cycles, especially in emerging economies, tend to recur due to economic expansions, government stimulus, and investor sentiment. Of course, there are always exceptions, but it's an exciting starting point. One of the biggest catalysts for a rising stock market, especially in China, is policy. As of late 2024, China has been rolling out new regulations and stimulus measures that make investing more attractive. The People's Bank of China, PBOC, has indicated easier monetary conditions, and the government is focusing more on innovation, technology, and sustainable growth. This support is crucial because it signals that policymakers are comfortable with the idea of a thriving stock market. It's a sign they want to encourage business growth and consumer spending. According to the South China Morning Post, these policy shifts include reduced tax burdens for companies in high-tech sectors, relaxed regulations for foreign investors, and an emphasis on domestic consumption. This is a big deal because a friendly regulatory environment often leads to more liquidity in the market and can fuel a bull run. Now, I know a lot of you worry about geopolitical issues, especially the tensions between major economies. Will these issues derail China's stock market? Many analysts actually say the risk is relatively contained. Bloomberg Intelligence notes that while geopolitical noise might create short-term market fluctuations, China's sheer economic size and the government's strong influence on policy decisions often help stabilize major market downturns. Sure, we never want to ignore potential risks, but looking at the data, it seems that the overall impact of these tensions might be smaller than many fear. Especially as China continues to refine its export strategy, develop internal supply chains, and attract foreign capital, the market could very well stay on a growth trajectory through 2025. Some skeptics say, but wait, Japan's market peaked around 1990 and then took 30 years to hit a new high. Could that happen in China? The short answer is, China's economic structure and growth engines are quite different from Japan's in the late 1980s. Japan was dealing with massive asset bubbles, particularly in real estate, and faced serious demographic challenges. Meanwhile, China still has relatively higher growth rates, huge domestic consumption potential, and a more flexible monetary policy framework. A World Bank report highlights that while China faces its own set of challenges, like aging population concerns and leverage in certain sectors, the government's tools to manage the economy are more diverse than Japan's were 30 years ago. This doesn't mean China is immune to slowdowns, but the differences are significant enough to suggest that a Japan scenario might not be the base case for China. If you need a real-life example, let's talk about Shenzhen, a city often called China's Silicon Valley. Companies based in Shenzhen have been receiving considerable support, pushing innovation in tech hardware, biotech, and AI. Some Shenzhen-listed stocks have seen double-digit percentage increases over the past few years, even when the broader market was under pressure. For instance, according to a CNBC report, several technology firms in Shenzhen have increased R&D budgets by up to 20% in anticipation of new government incentives. This is a powerful indicator that when the broader market sentiment aligns with government policy, things can move fast and furiously in China's equity markets. Let's get practical. How can you potentially benefit from a China bull market in 2025? Here are some actionable steps. Diversify your portfolio. If you have little to no exposure to China, consider adding a small percentage of Chinese equities or ETFs. This spreads your risk and taps into a different economic cycle. Example: look into diversified China-focused ETFs like iShares MSCI China ETF or Xtracker's Harvest CSI 300 China A-Shares ETF, which track broad indices. Focus on growth sectors. Tech, consumer goods, electric vehicles, renewables, and biotech are among the sectors that the Chinese government is heavily promoting. Example: companies like BYD, electric vehicles, and contemporary Amperex technology, battery tech, have seen consistent growth due to supportive policies and soaring global demand for EVs. Stay updated on policy. China's regulatory environment can shift rapidly. Keep an eye on official statements from the People's Bank of China and the National Development and Reform Commission, NDRC, to stay ahead of the curve. Risk management. Never allocate more than you can afford to lose. Even with positive signs, emerging markets carry higher volatility. Use stop-loss orders or limit your position sizes to safeguard your capital. Seek professional advice. If you're uncertain, consult with a financial advisor who specializes in emerging markets. They can help you navigate the nuances of China's regulatory and investment environment. If you're looking to stand out and potentially maximize gains, consider these innovative angles: private equity or venture capital. If you have access, investing in early-stage Chinese tech startups can be lucrative. Platforms like AngelList occasionally feature global opportunities, though you'll need to meet accreditation requirements in many cases. Green tech collaborations. China is one of the world's largest manufacturers of solar panels and other renewable energy technologies. As climate change initiatives expand worldwide, Chinese green tech companies could see massive gains. Cross-border e-commerce platforms like Alibaba or JD.com are always looking to expand their global footprint. If you have a business that can partner with them, or if you simply invest in them, you could ride the wave of new cross-border initiatives. These ideas carry more risk than traditional equity approaches, but if executed carefully, they offer higher potential rewards. I get it. You're worried about putting your money in a market that feels unfamiliar. That's totally normal. The Chinese market does have complexities: language barriers, cultural nuances, and rapidly changing regulations. But if you look at the potential payoff, tapping into the world's second-largest economy at a time when the government is actively encouraging stock market growth, it's definitely worth giving it serious thought. Here's how to minimize those pain points. Educate yourself. Read reputable sources like Bloomberg, Reuters, and the Wall Street Journal's China section to stay informed. Network. Join online forums or local investment clubs where people discuss emerging markets. LinkedIn groups and Reddit communities like R Stocks or R Investing can be valuable if you filter the noise. Start small. You don't have to jump in with a large chunk of your savings. Experiment with a smaller position to get comfortable with the market's movements. Now, to the big question, when exactly should I buy? Timing the market is notoriously difficult, but you can keep an eye out for official policy announcements, economic data releases, and fourth quarter 2024 or first quarter 2025 earnings reports from key companies. Look for signals of improving consumer spending or industrial production growth. Tools like TradingView can help you track technical trends in major Chinese indices like the SSE Composite or the CSI 300. So there you have it. Everything you need to know about why 2025 could be the year of a big China stock market boom. And more importantly, how you can position yourself to ride that wave. Yes, there are risks. Yes, there are uncertainties. But if you're looking for a potentially high-growth opportunity, it might just be the moment to start doing your homework on Chinese equities. If you found this video helpful, make sure to hit that like button, subscribe to this channel, and turn on the notification bell. We've got more videos on the hottest investment trends, market updates, and practical tips to help you secure your financial future. Also, comment below. Are you bullish or bearish on China's stock market in 2025? I'd love to hear your thoughts and start a conversation with you all. Thanks for watching, and I'll see you in the next one.